Hello, everyone. Thank you so much for tuning in to today's webinar on bridging the data gap between risk and finance. Today, we're so excited for a lively discussion on practical ways that financial institutions can share data more effectively across departments to mitigate risk and increase analytical capacity. We have two excellent speakers today, Eliud and Peter. We'll get into their full bios in just a minute. While we're waiting for a few more folks to join, here are a few housekeeping items. Firstly, please feel free to use that question and answer feature located at the bottom of your screen. We'll get them at the end of the call. And also, this call is being recorded and will be available for you or your colleagues to review after this webinar has concluded. And with that, Eliud, we're ready to get started.
Excellent. Thank you, everyone, for joining today's webinar. We hopefully will have kind of a very lively discussion around kind of what are the issues that are facing risk and finance and why is it so difficult for those functions to communicate, but not just risk and finance, all kinds of other business processes and functions. And so I'm glad to present Peter Serenita, who's going to be kind of our key presenter today. Peter is the chairman of the board at the Enterprise Data Management Council, which is a large nonprofit industry peer group, probably the largest global industry peer group of chief data and chief analytics officers. We're also happy to kind of announce that Peter is also one of the Fluree advisory board members. And maybe Peter, if you want to just kind of a little bit of a quick background about yourself.
Sure. Thank you, Eliud. Yes, I mean, I won't go into too much depth, but I became a chief data officer at JP Morgan in their Worldwide Security Services Division in 2006. So one of the early chief data officers. Then went over to HSBC and became their first chief data officer globally, and then Scotia Bank similarly to become their chief data officer globally. And so many years of being a chief data officer. So a lot of the gray hair and scars to go with it.
Great. And my name's Eliud Polanco. I'm the president at Fluree. I worked under Peter at both HSBC and Scotia Bank, and I also held similar roles in data management, data innovation, analytics at Deutsche Bank and at Citigroup. So lots of experience as well, kind of dealing with some of the practical challenges and issues of dealing with large volumes of data at scale in financial services. And currently we're trying to take a lot of the best practices and what we learned from some of the scar tissue that Peter was describing and building that into the Fluree product suite. And so we're very excited to kind of walk through what are some of the challenges and what do we think Fluree's answers to some of these specific challenges. If you look at the agenda and how we want to cover this thing, so we want to cover this in 4 sections. The first section is just to set the context and describe what do we mean by the thin risk gap. So what is the challenge? Why is it that finance and risk have such difficulty getting access to information, getting access to clean, trusted information? And what's the impacts of the challenge? Then we're going to look at how have CDOs traditionally tried to solve the problems using kind of some of the legacy techniques and technologies and tools that exist in the marketplace today. And then from there in the third section, we'll talk a little bit about Fluree's intended approach. So what is it about how we think about the problem that we think is unique and differentiating? And then the final step is we're going to spend a couple of minutes talking through just a high-level roadmap for where do you start and how would you kind of implement this similar type of function within your organization. So with this context out of the way, I'd like to pass it on to Peter. And what we're going to do is we're going to start first by just discussing and framing the challenge and just, starting off with the first simple question of what is it that risk and finance need and why is it so hard for them to get access to it? Peter?
Yeah, thanks, Eliud. And so part of my background is at one point I was also the chief architect, the head architect for finance. And obviously with BCBS 239 many years back, or still today, right? We were on the risk perspective, having to perform improved data management for risk. And even during BCBS 239, a lot of that crossed over to finance as well. So there it became very obvious that there wasn't an easy alignment between a risk and finance, at least from a data perspective. And this is historical. And if you think about finance and risk, first let's kind of back up and say, okay, what are finance and risk requirements, and how do those manifest themselves? And I do think that we have to be, clear that whilst finance and risk have a lot in common, they also have a lot in difference. right? Now, those differences are changing and converging over time and continue to do so. So at some point, we may see them actually be completely aligned. But historically, they were not. And so we just wrote up a few. I mean, I'm sure we can go spend a lot of time filling out this list a lot deeper and a lot wider. But a couple that are just, I think, very obvious and really did start to cause some issues are, finance really emphasizes accuracy over all else. And in fact, over timeliness. And if we think about the closing of the books, if you will, that's a multi-day process, depending on the organization. It can be weeks, and in other places, it could be days. But over that time, they're examining the accuracy, they're making adjustments and whatnot. So it could take several days to update, but the fact of the matter, at the end of the day, it needs to be correct and prove correct, all right? And so what they also tend to do is they tend to summarize things. If you think about the GL, and you think about some of the chart accounts there, it takes data, it takes transactions and balances, and it classifies them and then rolls them up. And so then they're dealing with data at a summary level. And depending on the organization, they may get the details and create the summary level. And other organizations from the business, they actually get the summary level. And so now all of a sudden, a lot of the detail that was previously identifiable is no longer identifiable. And I hesitate to use this word. I was about to use it, but I guess I'll use it anyway. And therefore, sometimes the lineage gets, and I don't mean data lineage. I mean the lineage of the balance, how it became that balance, becomes a little more obscured. So that's a very generalization about finance. And then risk is almost diametrically opposite. Risk tends to worry about timeliness more than they do about accuracy. Now, again, I'm generalizing. There are other areas of risk that obviously, spend a lot of time, calculating and re-emphasizing, similar to finance. But again, in general terms, they're about knowing the risk quickly and within a certain percentage of accuracy. And some of that will be daily, some of it will even be intraday. And so you can see those two very different characteristics start to drive different behaviors. And risk also does require the lowest grain of detail because they perform all these algorithms and analysis on the trade level, transaction level, balance level. And then they take in external factors to try and project and whatnot. So you can see right away, they have very different requirements. Not to mention, they also have very different vocabularies. They talk about these things very different. Debits and credits, buys and sells, and things like that. So again, these start to drive certain behaviors. So Eliud, if we advance to the next slide. Now, I've made a generalization just now, right? I talked about finance as if it was a single thing. I recognize that actually underneath that umbrella of finance, there are a number of different functions. We've called out 3 of them here. And also tried to look at some of the characteristics of those functions. What we tend to think about when we think about finance, we tend to think about the first 2. The books and records of the bank, the accounting, so the closing of the books. And so that is clearly, as I described, very much about accuracy. And it's very much about backward looking. What the transactions, or what are the transactions, how are they, what's their mark to market, or what's their profit and loss. And so because of the need for accuracy, settlements or whatnot, you could say I have a little bit of capital markets bent to it, global markets bent to it. But that's why they tended to get their data from the operations, or some call them back office systems, after they've been reconciled, after they're confirmed, after a number of operational processes have taken place. Regulatory reporting is not too dissimilar. Again, it's more obviously external facing reporting, whether it's regulatory reporting or statutory reporting, or even your annual reports and whatnot. It's similar to the books and records. It's backwards looking. It does need a little bit more detail sometimes on some of the regulatory reports, and over time that has grown significantly. And that's where I start to see some of that convergence. Then we have this other group, financial planning analysis or business performance management. Again, don't know what your organization calls it. They tend to be more analytical. It's more MIS for internal use, product profitability, location profitability, projections. So they tend to look at data from slightly different sources than regulatory reporting and books and records. Now they will take that in, of course, but they also look backwards as how things perform, but they also look forward to see how, if they made changes, how things will perform. So they really assist the head of the business with their strategy and try to identify whether the strategy worked, whether backwards looking stuff, or to help develop maybe a change in strategy with some forward-looking analytics or analysis. So again, those are the different characteristics, and you can start to see some of this stuff. Again, very different requirements, but they're starting to come together. We're seeing more and more, both on the regulatory side, and again, even on the internal reporting side, as well as the books and records, the granularity, level of detail required, the timeliness of being required is becoming more like risk. In fact, risk is starting to converge with their accuracy measures. So we're starting to see a lot of this converge. So if we move forward, and by the way, just a reminder, please do drop questions in the chat. If I happen to see it, I may answer it right on the spot, or we may save them till later. So please don't hesitate to enter some questions as we're going along. If you can advance forward, Eliud. Okay, so I kind of alluded to this. So where do these groups source their data from? And again, as I said, because risk needed it more immediate, they tended to get their data from front office systems, it wasn't necessarily reconciled. It wasn't confirmed transactions. If you even think of a retail checking account or whatnot, they do the intraday balances, but then at the end of the day, they recalculate all the balances. So they're getting it on day, or at worst case T+1, and so they were getting it from the front office systems. And on the right side, you can see that again, traditional finance areas would tend to get it from the mid office or back office systems on at best a T+1, and possibly even later than that. They also got things like, whether the trade settled or failed and things like that. So again, those are other aspects that they needed the middle or back office systems to provide to account for, the financials. And you can see here we have financial planning analysis. Again, they tend to get it from both, and depending on their requirements. So again, you can see a very different sourcing strategy. Now, again, this is converging. And again, we're going back in time a little bit. I want to move forward because I don't want to take all the time. We want to get to a good part of the meat of this discussion. So we can go forward, Eliud. So again, why is this so difficult then to bridge a gap? You kind of seen some of the difficulties, right? I often look for the same data, but getting it from different places. They do use different vocabularies. Sometimes those vocabularies also, when they use the same vocabulary, don't necessarily mean the same thing. So we really got to kind of tweeze away and really get down to where it actually is the same and where it actually is different. As well as when they use different terms, they actually may mean the same thing. So we really need to really understand and get down to that common out. I was about to say common language, but actually that's not the case. We want each group to retain its dialect, because it's an industry dialect. In finance, you're going to have certain dialects that are common across industry. Same in risk, and you're not going to change that. But you want to do is understand the commonality and the differences. They do, of course, all require their own business logic and transformations, because they're doing different things, right? One is analyzing the past, and they want to calculate cash flows, or they even calculate future cash flows, and they may use a different algorithm than risk would do, because they may add different parameters to understand possibilities of risk, both worst case and best case and things like that. And what tended to happen because of all this, and part of it was control, they tended to store their data in their own repositories. And they took the data from either the front office, back office systems, they transformed it into their own schema, and then they processed it. And then they created new data within, and even may have modified existing data. And so all of a sudden, these two repositories that you have, one in risk and one in finance, and again, I'm assuming one, in some cases it's even worse than that, now are not reconcilable to themselves, right? To each other. All of a sudden, got this divergence and difficulty going forward. All right. Go forward, Eliud. Okay, so again, what is the impact? We have now siloed risk and finance, quote, sources of truth, and no easy way to tie them together. We've got the regulatory expectations have changed quite significantly over the last number of years, especially since the financial crisis, which feels like so long ago, but 2008 and all the mini crises in between. And the expectation is when they get a report from finance and they get a report or data from risk, that there's some kind of commonality, that they can see that these reports actually are based off the same or similar information. In other words, they don't expect them to be the same, but they can see that, you know, their debits and credits match, you know, what the balance is and what the risk analysis says. And so there's some kind of correlation. And in the past, however, because we had these two different silos, and again, all the other problems that I mentioned earlier, that wasn't necessarily the case, and the regulators saw that. And in fact, to add on top of that, and so a lot of MRIs, MRIAs to companies or other similar things in other countries. And so some of the controls, you know, weren't there, right? Or they failed. And so we would, and then the other thing that's not on here that I'll add, I kind of alluded to it, is regulatory requirements are becoming much more detailed and much more frequent. So now we're starting to see that convergence of requirements across, whether it be regulatory reports, financial reporting, MIS, financial MIS, or risk analysis. So now we're starting to see that, and it's becoming difficult for companies to do that without a good, solid architecture that encompasses both risk and finance data, and we'll get into that in a little bit. Next slide, please.
Okay. The only other comment that I would add, Peter, is that to your point, because the needs of risk and finance are converging and because they were historically kept separate, so you're now seeing double the cost, right? You're basically saying, look, all the investments in data infrastructure that we did for risk to make it more timely, we now have to like add it into finance, and then all the stuff that we did in finance, but all the quality controls, you got to add it into risk. So it's actually now you're seeing like major investments, like just a huge growth in the cost of the investment just to make sure that they can keep track with all the regulatory requirements on risk and finance. And so that's usually a symptom of something that's not going in the right direction when one of your fastest growing expenses is your data architecture for risk and finance alignment.
Absolutely. Yeah, costs and future cost as well, right? Because every time you have to make a change, all of a sudden you're having to duplicate that change at best. And not to mention all the reconciliation that happens behind the scenes. So CDOs, how did they try to address this, right? So one of the things they tried to do is a common sourcing strategy, and that was and you'll see some diagrams later, so I won't get into this too much, but they'll pull data into a common area so that risk, or they'll send the same data to risk and finance, or they'll do a pull for risk and finance to share data. And we'll get into some of the good things and not so good things about that. The common vocabulary and data dictionary to converge on meeting. So, you know, a lot of folks have bought data dictionaries and have associations of the different terms to at least say this is actually the same as that. And then there's finally the data implementation strategy. You know, they've actually, like I said, created these data warehouses or data lakes or data warehouses or staging areas, depending again how the architecture looked, so that they would be pulling from the same place. But they still had to address then I'd say the most, I would not say the least common denominator, but it's probably the most common. It's the hardest requirements had to be addressed for all, right? So again, if finance needed their data in the day, but risk needed it sooner, they'd have to source it sooner, and then finance could pick it up. So you couldn't relax requirements, if you will. So let's get to the next slide.
Peter, really quick, we had a quick question on the impact. Someone asked, how many banks today actually fail their audits or fail below regulatory expectations?
Yeah, actually it's very hard to come by number, but through my industry experience and talking with my peers continually, not just in the US, but globally, many, and let's say most, and it's probably true, most banks have some sort of data issue that the regulator has identified and they're working on. You know, the level of severity varies, and you know, some are very public. You know, at least in the U.S., right? The MRAs, matters requiring attention, MRIA, I should define those terms, matter requiring immediate attention. Those are private between the regulator and the company. But then there are others that once reached further, the consent orders, the DPAs, the data deferred prosecution agreements, which are much more severe, which aren't always data related, but there's a progression. And some of those are more public, and because they're public record. And so it's a little hard to know exactly the numbers because they're private between the regulator and the company. But again, through my informal network, it's most financial firms at least have one or two or more that they're working on.
And I think obviously the complexity of the organization is highly correlated to the issues that get found. So I think if you look at most of the tier one, large, global, systemically important financial institutions, we can probably bet dollar to donuts there's at least one specific, whether it's an audit finding or there's a specifically kind of regulated kind of report around a specific issue on a failed audit. I know in the US, as part of Dodd-Frank, they do publicly write reports that describe who passed and who failed their qualitative stress tests. So it's not a big secret which of the big firms are having a really difficult time. This qualitative stress test is mostly focused around, do you have controls around the process of financial reporting? So yes, you can generate a whole bunch of numbers, and the numbers reconcile, the numbers tick and tie, but do I trust the process qualitatively that generated those numbers? You can probably see a lot of that publicly available information. You can see that most of the top tier one banks are still having issues on the qualitative perspective.
Okay, and so Kevin, I have my chat open. I didn't see it, so for whatever reason I don't see chat, so please do interrupt. And I'm running kind of long, so I'm going to kind of zip a little bit through this. I kind of alluded to this, so this is a nice pictorial version of what we talked about. A lot of times, it's a little subtle here. You can see the risk group is actually going through the middle office straight to the front office arrows. And then you'll see the finance group going through the middle office version of those. Now, of course, those middle office versions are fed from the front offices or the operations versions, and there is a reconciliation process. But you know, again, separate equals different. And then you can see they stage it, they transform it, and they consume it, they use it, and then they, again, all within their warehouse, and never makes its way back into the operations of front office systems. So any changes or differences is then isolated to those silos. Let's move on.
One thing I was going to comment on is, so first of all, this picture is probably dramatically oversimplifying the complexity. Like if you were to actually see the real arrows, it would look like a complete spaghetti diagram, because people, it's like the Wild West, right? People just go out and grab what they need. But then what happens is, because finance had slightly different quality requirements compared to risk, so finance will basically take a bunch of data from front office and middle office systems, but then they will run their own data quality rules and they will remediate their own data. And what winds up happening is that the divergence of what's inside the finance data warehouse compared to what was in the original source system or what was in risk, completely different, right? And I'm sure that for whatever critical data elements that risk considers important to itself, it will also go through it and try to remediate and fix the data inside its own data warehouse for it to run its models and for it to run its calculators. So that's where you're starting to see in this picture a tremendous amount of divergence that's probably understated in this picture.
I think the same is true if you look at every one of the slides. Right? Like I said, we could spend hours on each slide, but I think what we're trying to do is get some of the main points across. So you're absolutely right, Eliud. I mean, this is a very clean. In fact, you'd be happy with this slide if your organization looked like this. You'd be like, that's not so bad, but it is. So let's move on. Again, some of them tried to solve this with common sourcing. And again, you know, whether it be through Hadoop, data lakes, Snowflake, or you know, software de jour. But again, the same problem existed where things were still kept within their own areas. Part of that was a control reason, a cultural reason. We're not going to hit too much today on culture, but it's an important aspect. A culture of having control over your data sounds like a good thing, but actually isn't, because you're having control over not just your data, others' data as well, and everyone having their own control over copies of data clearly leads to problems. And again, it's not through bad intent; it's through, you know, good intent, but it manifests itself in physical copies of different data. And so we haven't broken the silos. We've broken the sourcing problem, but we haven't broken the silo problem. Okay. Again, data quality and lineage, how do you trust which one is right? There's lack of sharing, especially as it relates to things that are done to the data, whether that's calculating, doing an adjustment, creating a new piece of data that tended to get sent out similarly into different silos. It's really a one-way data flow. Majority, and again, you'll see different examples like on RWA's put back into the system, but those are very bespoke and very specific. For the most part, all the adjustments are held within finance and not shared back to the operation system or risk or whatnot, et cetera, et cetera, et cetera. And similarly with risk. So it really reinforces those silos slightly down the line. Instead of silos being up front, now they're kind of mid to back. So we're getting better, but we still haven't solved the problem. Next slide. Okay, so I'm going to kind of set Eliud up here, and I'm going to kind of turn it over to him. I will chime in similarly to get some key points out. But hope is not lost. This is, as I said, requirements version and technologies have improved to a point where we can solve this problem. And so Eliud's kind of going to walk through first conceptually and then physically how this would look. And please, again, happy for questions, comments to help make sure that this is well understood. It's really some important points here. So Eliud, do you want to take it away?
Excellent. So this is just going to kind of come back and just play back to some of the key themes that you've identified as you're describing the issues with the current state. So as we talked about, it would be nirvana if everybody could agree on speaking the same vocabulary, but we know that that's not realistic. And so we need to be able to say, look, there's going to be variations in jargon and taxonomies and in vocabularies. We'll call them dialects. So we need to be able to support the fact that risk is going to have its own set of terminology, and finance is going to have its own, and the enterprise may have a certain common one. And we have to be able to say, look, it's okay for us to be able to have different dialects. However, we should not be in the trap of continuously doing a lot of extract, transform, load, physicalizing copies for each source system. So one of the next things is to say, how do we create different semantic views of data without having endless copying? We've got to support bidirectional data sharing. So the second that risk has introduced a set of data that might be useful for finance, if the policies allow it, then finance should see it just as soon as risk publishes it, and vice versa. The second that finance publishes a set of transactions with the correct adjustments, some of that data should be available to the risk models and the risk calculators. And so how do we enable that two-way flow of data, obviously protected and controlled with privacy and security access control? And then a final thing is, this architecture pattern needs to be supported whether we're talking about a simple bank or a complex bank. In the really complex banks, you're talking about hundreds of front office systems, hundreds of middle office processes, and lots of different systems. And so, as you said, the pictures can get really complex. But even in the regional and kind of the local, let's say, credit unions, even if we're talking about 2 or 3 different systems, you still fall into the same trap of taking the same data, even just coming from one platform like FIS, but you're going to wind up creating so many different copies of that you'll wind up creating complexity even out of a pretty simple infrastructure. And so that's why I want to make sure that this pattern that we talk about is something that scales up to the complexity of the organizations that we're talking about. So here's kind of a high-level picture of what the pattern looks like. And central to the pattern is this idea of what we call data centricity. And in a data-centric pattern, the idea is that the functions are going to come to the data, as opposed to data getting copied and pasted from the repository to the function. And so here, the really critical thing is this ability to have this enterprise data assets repository, where data will come in from front office systems and middle office systems. Today, day one, you may have the staging layer, but ideally there's a direct path from the front office systems to the middle office and the middle office systems directly to read the data assets. And then as they're creating cleansed, consumption-ready data assets, there's a way for this information to be distributed at whatever timeliness requirements are needed for the risk applications and the finance applications, and with whatever views that are required of the data and whatever dialects without requiring separate physical transformations of the data. And then, as we said, when the functions have processed data, they will put the data back into the same, we'll call it virtual repository, such that it is immediately, again, made available to front office systems, middle office systems, and any of the other functions. Okay, so that's kind of the idea of saying we're going to put the data in the middle, and then we're going to have all the functions, the front office functions, middle office, risk, finance, everybody, you guys get your data from one place, process it, and put your data back in the same place. And as we'll talk about, this is a conceptual picture. It doesn't mean that they're all physically writing to one single physical system, but it is kind of one conceptual system, which we'll kind of describe and talk about. Okay. Now, this is where we kind of talk a little about Fluree and kind of Fluree's vision, how we support this data-centric architecture. So for those who don't know, Fluree has 2 core products. There's one product which is called our Fluree Core, This is our, what we call collaboration data platform. So it is a database that was designed with real-time sharing and collaboration in mind, with high levels of security, access control. So think about it kind of like a zero trust, I won't say fully decentralized, but think about it as a platform or protocol for sharing data inside companies or companies and their suppliers and partners and peers. But it's a highly new, kind of a new way of sharing data across a company that doesn't require having to physically do a bunch of ETL to copy data and save in data warehouses. And then we have Fluree Sense. And Fluree Sense is a data pipeline tool that uses AI and ML to take legacy data where we have lots of discrepancy, lots of redundancy, but uses AI and ML to clean it, integrate it, master it, resolve it, put semantics on it, and then get it ready for Fluree Core. And if we go back and we look at kind of our target state pattern, the way to think about it is you can use Fluree Sense as a vehicle by which we will take the front office and the middle office data that today are in their silos and running it through the Fluree Sense pipeline. The idea is that Fluree Sense will have a set of resources and utilities that will facilitate the process of creating these masters. And the idea behind this picture is that for most business use cases in financial services, even beyond just thin risk reconciliation or thin risk matching, for anything as it relates to know your customer, cross-sell, upsell on the marketing side, if you have cleaned and accurate customer account product transaction data, then that's really what we call kind of the core legacy, the core real underlying and foundational data asset. With that asset in place, this really does drive the bulk of your data use cases. So think about Fluree Sense as a platform that enables the creation of these cleansed integrated data sources. And then think about Fluree Core as your data serving layer. So you can publish your data in Fluree Core and then take advantage of kind of Fluree Core's unique technology, which integrates blockchain, it integrates the knowledge graph, it integrates kind of a zero trust framework to allow the functions to come to the data without having to create all kinds of physical copies of the data and without having to force people to fit the data into one specific system, right? So you could have the data physically hosted in different on-prem environments, different cloud environments, but as long as they're operating on a common protocol, the data can be available and exposed to whichever functions needed based on privacy and access control.
Eliud, we had another great question. Oh, so go ahead, Peter.
Yeah, I just wanted to emphasize a couple of key points here because I think it's worth pausing a little bit, and it kind of really illustrates some of the capabilities that solve the problem, right? First off is, Eliud, you mentioned, let's not make more copies. You can see there are no siloed copies here, right? Like in the previous picture. The other thing I wanted to mention was that semantic view bar there. A lot of companies will have different data dictionaries and they'll try to manually converge those data dictionaries. What this semantic view is, it's actually automated the creation of that semantic view when you identify what each group wants, the logic, and I'm stumbling here a little bit because obviously Eliud is far more technical than I, but it creates those associations. And so what we're not suggesting here is there's a huge manual effort to create those similar semantic views. And again, to be clear, it's working off the same data, but it has the dialect of risk versus the dialect of finance. And those associations are automated. So, and it does not require a copy of the data. It's kind of a see-through, if you will, with a different dialect. And I think that's usually important. You don't have to manually create that association. The AI logic in Fluree Sense will create that association. And then at runtime, the Fluree Core identifies and recognizes that. So it's really solves the problem, if you will, of these constant copies. The other point I wanted to make, you mentioned the clouds. A lot of people have a dual cloud strategy and, trying to get the data from one cloud to the other cloud, trying to figure out what's on-prem. This basically is a catalog, a traffic cop that says, here, I want this data, and whether it's on this cloud, that cloud, on-prem, it figures it out and gets it for you. So it really does, from a consumer point of view, simplifies because you can stay in your own dialect and you don't really have to know which cloud it's in, on-prem or whatnot, and it really does serve the consumer. The final point I wanted to make, and apologize, Eliud and Kevin, is the auditability that's associated with it. Because of the technology under Fluree core, anything that has, so there's that trade database there, that repository there, right? And somebody can modify that trade repository. Well, we keep, the Fluree core keeps every single copy of the historicals, and it knows exactly who did what to what. So there's a backtracking that you can easily identify what happened and who did it and whatnot. A fantastic automated audit trail, if you will. And so again, you can go backward in time and rerun stuff with what it looked like back when. So sorry, I dominated that call, but I think those are like hugely important distinctive points that you don't see many places.
Thanks,
Kevin,
Peter.
was there a question that we had from the?
Yeah, we had two coming in on this slide in particular. Stephen asks, is this analogous to a data fabric?
So I'll answer that one. So we'll say, so data fabric is one specific type of implementation. The terms are so, it's kind of a new term, so it tends to get associated to a specific set of vendor products, a specific set of kind of fabrics or meshes or certain things regarding specific vendor products and how they interact with things across clouds. But the idea or the concept of saying, we want to be able to create kind of a virtualized, decentrally managed set of data that can sit across multiple physical stores, that has a layer of semantics so that the different processes can access and understand the data. That's fundamentally it. And I think the easiest way to think about it is Fluree core is a specific type of implementation of a data fabric that really emphasizes zero trust and really emphasizes a lot of the kind of capabilities around.
Explain that a minute.
Yeah. So the concept of zero trust.
Do you want to explain zero trust? Because I think it's counterintuitive,
yeah.
Quite frankly.
So zero trust means there's no such thing as a trusted zone. And we took this terminology zero trust from the network space. Typically, the way most networks were laid out, there was a trusted zone and an untrusted zone. And if you authenticated, you got authorized, then you'd get access to the trusted zone. And then once you're inside the trusted zone, you could do whatever it is that you wanted. And after COVID and when everybody started working remotely, the idea, the concept is that there's a trusted zone where if you get authenticated, then you can go ahead and query and access whatever data that you wanted. That concept kind of went away, and they basically said, I need to be able to authenticate you and authorize you every time you want to take any single individual function, because I don't trust anyone. And so in essence, what this means is that every single request or access at query time has to be wrapped around the policy. And the policy will allow you to determine who's allowed to do what, who can write to the database, who can read from the database, who can query it. And so that's kind of the unique thing that we have within Fluree core, which is what data is available or visible for you to see across any of these assets is entirely wrapped around the policy. The policy and the data are not separate. The policy lives with the data, such that if anybody had access to the data and they didn't have the right to see the data, then they wouldn't be able to access it.
Or portions of the data, right? So if you can say, well, this person allowed to see the data, but not social security numbers, or what, you can be, well, this other person could see the entire data and things like that. So, and I think the reason I asked you to explain zero trust is it's counterintuitive to what we talked about earlier. We said by default, all data should be shared, right? Which is not what happens today. Today, you have to specifically be authorized. You can access. I'm going to send you this data. And you can, and then you lose control of it. What we're saying here is risk. You need to share your data. Finance, you need to share your data. And by default, you should assume it's going to be shared and used by all. And then obviously we have the policies that will, do the appropriate thing and restrict it, as you said, but not in a static way, but in a very dynamic way.
So in the interest of time, because I want to kind of quickly run through, so how do you actually, what does this picture look like if you try to implement it? And then we'll come back and there's going to be some other questions and kind of circle back and answer those questions. So what I want to first focus on this left side picture, which is how do we create the enterprise data assets to begin with, given that most of the data that we have is in our legacy silos over here on the left side. So this is where we have Fluree Sense. There's 3 specific modules or utilities within Fluree Sense. There's one which is called ingest. Ingest is purely your data pipeline or your data movement tool. So if you have to grab data from a source, and then if you need to do any kind of copy or transformation of the data, which initially we'll need to because we want to get this data in whatever form it is, and then we want to create it in a semantic form. So for that initial first set of flows, the orchestration, the collection of the data, Ingest is kind of like our low-code, no-code data pipeline tool. It's like any ETL tool, like visual ETL tool that you may be familiar with. Classify is kind of the unique differentiator here. What Classify does is Classify allows you to load your vocabularies, load your dialects, and then use machine learning to go and say, go help me find and help me figure out how to tag the original legacy data or the raw data with the correct terminology. We'll show a couple of screenshots just to kind of make sure we can kind of provide a better picture of how that works and what that looks like. But the goal here, and this is kind of going back to something that Peter said, it's always been very difficult to physically stitch. I have business terminology on one side. I have physical technical metadata on the other side that describes tables and columns. How do I connect the dots between the two has always been a very manual effort. Or we've seen a lot of software products try to do this using rules-based systems, which don't always work because the data doesn't neatly line up to specific rules. So Classify is our methodology or our attempt to try to help solve that stitching problem. And then Resolve is kind of like our answer for MDM. So again, it's a low-code, no-code, MDM-like utility. If you're familiar with master data management systems, this is about integrating data from multiple sources where you could be describing the same type of entity in different systems that could be duplicative. And so what we need is we need a process to match records across different sources and then merge them together and create golden sources of truth. So Resolve is kind of like our analytic AI-driven matching and merging process. And just to kind of provide a couple of screenshots to give some examples. So this is a screenshot of what the Classify system looks like. And the idea here is that you can start to ingest into the Classify system all the different vocabularies and dialects that you have. So for example, here we've got a data dictionary that's describing the universal banking model. So this is one that comes out of the box within the Fluree Classify system, but you will obviously have your own data dictionary. And then risk will have its own vocabulary and finance will have its own dialect. And so the idea is that we're going to just take all of those dialects, we're just going to load them into the system. And so this is kind of one level. This is looking at things at the business subject area level. If you go down one other level, you can see you can get down to the individual, to an individual concept level, right, or a specific term. And ultimately, the goal or the question that we're trying to solve for is, where do these terms exist? So in this case, we're looking at something called a payment. If I was to scan all of my front office and middle office systems, can I teach the system to go and find payments? And then come back and tell me, okay, I've not only found which sets contain payments information, but I could tell you which columns within those data sets contain the purpose, the transaction channel, channel risk, execution date, etc. Now, the goal or the trick to make this stitching happen is it's got to be smart and it's got to be automated. So the idea here we're looking at one specific business term called previous business name. And then when we go back and say, can you identify where is the previous business name? And then this will run through an AI classification system. It'll go through and try to find all the different tables across all the sources where it contains something that could correlate to something called previous business name. And then the idea is that you give thumbs up and thumbs down. And as you go through this process of reinforcing the model gets pretty smart. And the model will start to draw and make connections. And it'll come back and say, okay, I get it. What you and risk call the asset execution date or transaction execution date is what finance calls the settlement closing date. Great. Let me start to draw those connections, and we're going to start to put this into a knowledge graph. So the idea is we're going to start to connect the dots and say, I understand how certain columns map to certain terms across multiple vocabularies. And when we put it in a knowledge graph, we start to create kind of like a mapping diagram or picture that looks like this, where on the left side here in gray, you have different tables. On the right-hand side, you have your semantic object. You have your business subject area, the term that you're trying to describe. And then the system's going to try to go through, scan, and try to connect the dots. And obviously, we know this is a fairly simplistic picture. In a lot of data sources, the data is highly normalized, where it's chopped up into little pieces. And you have to, in order to kind of create the view on the right side, you have to join data from lots of different tables. So the system will not only try to discover those relationships, but it will also try to discover a lot of the primary key foreign key links. And it will try to figure out how to connect the dots so that if we wanted to physicalize the data structure on the left to the target model on the right, then it would automatically go ahead and create the business logic or the data pipelines to go ahead and create that transformation.
I think that word that you use is usually important, Eliud, because I think when people look at this diagram, like, oh my God, I have to do this. And the word automated is usually important in that, this is a good visual representation, but the fact of the matter, the system builds all those relationships.
That's correct. Yeah. So then the final step here is when we get into the actual matching and merging. So this is where we get into, this is the other Fluree Sense component called resolve. Resolve is interesting if you wanted to take, for example, accounts or customers or products that are described slightly differently in a different system, but we need to have some commonality before we can actually send it for distribution to risk and finance. So in this example here, right, I've got multiple identifiers for a specific entity called Kruger Incorporated from different source systems. And so this would automate both the matching of that record across multiple source systems, as well as if we needed to merge it to a common vocabulary, then we may need to pick the date from, like the date of incorporation may be correct in one record, but the address may be correct in a different record. How do we pick and choose what's most likely the correct information record by record in order to create that golden source of truth? Again, these are AI ML models that you can train and teach the system how to run through that so that it would go through and kind of generate these golden records for you. Now, once we do that, then the next step is to publish this into Fluree Core. And in Fluree Core, the idea of the concept here, and I want to come back to the question on the fabric. So the idea here is don't think about this like a traditional relational database. Think about this, as I mentioned before, it's a mix of knowledge graph and blockchain. And the idea behind knowledge graph is that you can save in the knowledge graph all these different discovered semantic relationships. You call it party, I call it customer, right? You call it counterparty, I call it the guarantor. They mean the same thing. Those are the kinds of relationships that can be saved inside a knowledge graph. And then you can facilitate those semantic views that Peter was talking about earlier. So if I want to query the data and say, get me all counterparties, whether I physically originally save the data as party or client or customer, if there's a semantic relationship that says, in this context, counterparty is equal to client, then you can query the data within Fluree Core using that context without having to physically recopy the data. So it's just another way to enable your business functions to connect to data in the vocabulary that it understands without having to make another copy.
I just want to add, I just want to add, because you use the word connected data, and that's usually important as well, right? Because traditionally, right, when you're in the risk repository, they put a certain customer number to it. When they're in the financial repository or the operations repository, it may have a different customer number or name or whatnot. But the fact of the matter is, once you put it into this area, it normalizes that and it connects the data. So now we're talking. And I think that, I know you use the term MDM and whatnot, but I just wanted to kind of emphasize the point that it's great to have these individual repositories that are not duplicative, but it's even better when the cloud.
Okay. The other comment that I wanted to make on this picture is that Fluree Core doesn't operate on a traditional model of tables and columns the way you'd expect in a relational database. Any data, any piece of data is just a block. And that block is immutable. It has a unique ID. Any changes to the block will create a new block of data, and you'll have the full lineage and chain of custody and the history. And as Peter mentioned, you can travel back and forth through time. But you can then connect or compose and link all these blocks together. And then depending on policy and access control, right, you can then determine who has access to see what blocks of information. So it's very easy for the risk guys to go through, create their own ledger, generate their own blocks using blocks from the enterprise ledger. And anytime there's an association where any block of data in risk was created from a block of data from the enterprise ledger, that chain of history is in the blockchain, right? So you'll be able to trace it back and say, I know exactly where this specific block of data that risk is using came from. And then if risk wants to share block finance, then they would just adjust the policies around those blocks of data and make it immediately available to people from finance. So you may come back and say, I want to share with finance specific elements, specific blocks of risk exposure data. The second that risk writes it, finance, if they get authenticated as someone from finance, they would be able to get access and view those blocks. And they'd be able to query it using finance language as long as there was a semantic relationship that was established between how finance describes risk exposure and how risk describes risk exposure. Okay. So this is really kind of like that physicalization of this diagram that we were talking about before, which is we're using the knowledge graph to generate the semantic view. We're not really saving different data sources in different databases or different warehouses. We're just saving blocks of data, and then we just connect and link the blocks at query time based on whatever it is that we need, as long as it's allowed to by policy. Okay. Let me just, I know we've got 10 minutes. I do want to pause. We have one more section that we need to cover, but I do want to pause here and see just, Kevin, if there are, I kind of ran through a lot. I want to pause and see if there are any questions so far that have come up on just a fast run through of Fluree Sense and Fluree Core.
Yeah, Eliud, there were a few. Alan asks a technical question. Is this using R2 RML under the covers when the source is relational? And how about when the source is semi/unstructured like Mongo?
Yeah, so this process of taking data and applying semantics to it can be applied. So the assumption here is that we're talking about either key value pair documents like Mongo. We're talking about if stuff is already in semantic form, if it's already like an RDS turtle, which most data is not. Our assumption here is that we're dealing with the worst case scenario. It's all like flat files, CSVs, RDBMS tables, mainframe EBCDIC files. So the idea is that we're going to run through this process of taking the data, we're going to apply the semantics on top of it. Once you apply the semantics on top of it, then we can take that data and convert it into an RDS. And for people who don't understand, RDS is kind of the core knowledge graph data format called the resource definition framework. It's the thing that allows you to define lots of different semantic relationships on top of one same block of data. So I hope that answers that question.
Yep, we have just one more, and Peter, welcome back. Looks like you had some technical issues.
Technical difficulties.
No problem. George asks, and I believe this was when you were showing more of the conceptual diagram, Eliud. How is sharing in this diagram different from a centrally hosted database where multiple users can read and write to?
Yeah, so I know that there's a lot of stuff like Starburst. I know that people are trying to set certain things with like Snowflake or with, let's say, Databricks data sharing. I'm going to have to cheat a little bit and say how we share data. If we set aside kind of zero trust, so the fact that zero trust is a key differentiator, meaning in most of those systems, you would access or you'd provide roles-based access control, or at best attribute level access control. Here, what we're talking about is much more granular with zero trust, much more specific and granular levels of control that are much more robust than typical attribute-based access control systems. But there are also a ton of other benefits and features of kind of this kind of block approach. There's a specific paper that talks about data centricity and what's really different between trying to share data using something like a data marketplace solution from a cloud vendor or like Starburst. There's a lot of differences, but one of the big ones is going to be around this semantic interoperability, the ability to have you query data and say, I only speak risk vocabulary, and so you speak risk, I speak finance. We're going to query the data, even though the data was saved in a certain format. The ability to kind of query the data with your own schema at query time is a pretty unique and novel thing that we see that really helps facilitate data sharing in a way that it's not really viable with kind of traditional RDBMS-based systems that do this.
Yeah, so you're enabling different domains to work with the data in the ways in which they want to work with the data, but allow it to be semantically describable to the rest of the organization. We have a few more coming in, but if you wanted to roll through, Eliud, I know that we only have 10 minutes.
Okay, so let me, so I'll just quickly just restate why we like this approach. So obviously, as we've been talking about, a lot of this is using the power and scale of machines to do the heavy lifting, as opposed to like letting people try to do the stuff manually. It's much more resilient and open to change compared to doing stuff with ETL. If we do this thing correctly, we should start to reduce the amount of copies of data that we have, because we're now going to start storing the stuff in reusable blocks of data as opposed to creating lots and lots of ETL copies. And then, like we said, the ability to have immutable data with lineage and traceability, so that every time something is consumed or something is created as a result of a process from something else, just being able to trace the chain of custody there will dramatically address some of the qualitative issues that we're talking about that are still beating up a lot of the tier one banks as they're failing their audits and failing their stress tests. So last thing that we wanted to cover, we've got 5 minutes, is, so what's a practical way to get started, right? And obviously it's going to take some time to adopt the full big picture. So our recommendation is to kind of follow this 4-step process, but really focus in on what we call kind of the 5 key domains, right? So if we can start to just put our arms around customers' accounts, products, transactions, and securities, and say, let's just define at a high level, what are the key terms that risk, finance, and the enterprise as a whole are going to use for those specific assets? And we're going to take those terms and we're going to just import them into Fluree Sense Classify. And then what we do is we say, great, now let's run through, let's take one domain, let's say take trade or transaction. And let's say, okay, let's run through the process and let's train the system and teach it to go through and say, can I connect the dots between how all the front office systems and how the middle office systems, what they call transaction security data, versus how finance wants to call it and how risk wants to call it. And we want to now start teaching the AI model how to connect the dots between the various different vocabularies, right? And so say it would take about 6 weeks to get a domain pretty well trained if you have the right people involved. And then once you start doing that, you can then take those models and then start expanding and opening it up. So let's say once you get trade and transaction, now let's focus on customer account product. Now, customer account product, in addition to needing to normalize the schemas, we also have to potentially normalize the content itself, meaning we have to master the data because you may have 2 different customers with 2 different customer IDs. And we need to be able to connect the dots that customer 123 in product database A is the same as customer BCD in product database B. And we want to create those relationships and save those in a knowledge graph, right? So this is where we would then say, okay, a good next step would be to migrate from classified to resolve and then start to do some of the analytic MDM work. And then once we've done this, we can now take the data is going to be ready such that it can be imported into Fluree Core. And so the last step would be to say, initially you can serve the data out in your existing data warehouses, but then over time think about how do you start to decommission the existing warehouse and just start reading the data directly from the common data serving layer. Okay? And then over time, you'll see that as you keep reading and writing from the same kind of data fabric or reading it from the same collaborative data platform, you'll start to see that all these different analytic copies start to get less and less used and they can start to get decommissioned and retired. And so just kind of just a high level, very high level flow of one way that we can kind of go through and just take bite-sized steps, but make meaningful progress towards achieving that target state vision. All right, we've only got 2 minutes left, but
the only thing I'd add is also any new requirements then should be directed towards this. So if I have a new requirement for transaction or an analytic that's going to need transaction customer, point them to this environment instead of continually to create debt by connect them to the old environment, if you will. And if they have additional requirements, that's how you organically build this environment, right? So you add something else, you add something else, you add something else. And so all your new capabilities will be built on top of this. And then over time, to your point, you can migrate some of the, more I don't say legacy, I hate that word, but existing maybe is a better word, existing uses over. But I think it's important that, you can connect with a project that's really kind of a business driver that will then help you organically grow this. So are you going to ask for questions, I think?
Yeah, great. I know we've only got about a minute left, but are there any questions, Kevin, in the queue?
Yeah, so if you do have questions, please add them. I have a few here for you, Eliud. How is Fluree different from graph databases like Tiger Analytics or OnToText? The second follow-up to that question from the same person is, how do you deal with unstructured data, such as PDFs?
Yep. So two great questions. So the first question is, if you were to put us on a spectrum, and if you look at how we see the data space moving, so we're starting to see the emergence of what we'll call these kind of zero trust auditable databases. And you're seeing there's a whole new theme, like Amazon, for example, has something called the Quantum Ledger database. MongoDB is kind of creating their own blockchain database. So you're seeing that there's this bifurcation where some databases are being built that are really focused on that zero trust immutability of the data, the time travel. And then there's separate databases that really focus on the semantic interoperability. These would be things like Tiger Graph, like Neo4j, so the usual kind of property graph and knowledge graph databases. And really I could say kind of a major difference is we try to blend the two. So we have kind of that zero trust backbone with the immutability and the auditability and the lineage of the data, along with the semantic interoperability that you're getting from your typical knowledge graph systems like your Tiger Graph. Okay. The second question relates to how do we deal with semi-structured and unstructured data? So Classify today does have some components that deals with semi-structured data, and we're working on some enhancements that'll be coming hopefully pretty soon that will look at how do we do things like metadata tag documents to kind of like load in, for example, the PDF of your loan agreements or your various different kind of credit trading agreements, and how do we go through and tag it and find the information and tag it. So that's going to be kind of the next evolution of Fluree Sense and some of our classification capabilities, which will be moving from structured and semi-structured data to expanding to cover more unstructured data.
Great.
I know we're a little bit over time. I did want to ask if we can, and I forgot to include it here, Kevin, but we should publish the data-centric white paper. So there is a white paper that Peter, myself, and a colleague called Julia Bardmester, who's kind of one of the leading kind of thinkers from a data governance and from a culture perspective on how this changes things. A lot of the detailed questions around how is this really different? Why is this different? Like, how does this compare to X? A lot of these questions are going to be answered if we take a look at that white paper. It's broken out, it's actually 4 different papers. So it's broken out into 4 different chapters. But I would ask if you're really interested in the subject, we were able to kind of communicate a lot more about what makes this unique and novel, and we think more efficient to help solve the finance risk bridging problem compared to some of the traditional technologies in that white paper.
Yeah, so for all the attendees and everyone registered, you'll get an email with the link to this webinar on demand for you to review or send, and I will also include that white paper. And then I'll also just put a plug in. Peter and Eliud both are joining Julia Bardmester, ex-Chief Data Officer over at Voya and the founder of Data for Real, on June 6th, I believe. The Enterprise Data Management Council is hosting them on a webinar that covers more broadly the topic of data centricity and the move both culturally and from a governance perspective and from a technology perspective. So I'll include all 3 of those links in our follow-up email. We are 3 minutes over, so thank you very much for staying on with us. And Peter, thank you so much for lending your time and your expertise. It's very welcomed. Okay, everyone, that concludes our webinar.
Enjoyed it. Thank you.
Take care.
Bye-bye now.